Using private money is a fantastic way to fund your real estate investments without having to qualify or go through the hassle of traditional bank financing. You might be wondering, how do you actually structure the details of a private money loan? Well, in this video, I'm going to share exactly how you do that using an example, and we're getting started right now. To give you an example of how to structure a private money loan, I'm actually going to take you to a clip from a course taught by me and my longtime teacher, Dyke Spotterford. The course is called Creative Financing for Real Estate Investors. And if you like this clip and if you want more information about the course, you can find a link to it in the video description below. Let's get started. All right, so we're back at another lesson, and we're going to talk about how to structure private money. This is a big topic, and as I mentioned in the intro to this module, there are many, many different ways. As creative as you want to be, one of my favorite parts of this business is that there are so many creative structures, but we want to give you some building blocks or some tools in your toolbox, to use that metaphor again. And we're going to start with some of the basic ones that you can then use and have variety later on as your deals warrant. And so the ones here's a preview of what we're going to cover in this lesson. We're going to talk first and foremost from a different time frame, thinking about different time frames of different structures. So we're going to talk about short-term loans to start. We're going to talk about short-term fixed interest private loan, kind of one of the simpler versions of what a private loan could look like. Then we're going to talk about some variations of short-term private loans. So we're going to add a little bit of nuance to those and some other tools in your toolbox for the short-term loans. Then we're going to go to if you're thinking about buying properties with private money for long-term, which I've done a lot of, some of my rental properties. We're going to talk about a fixed interest long-term private money loan. That'll be kind of the base building block we'll cover. And then we're going to get into some variations on how you might be able to add or change around that long-term loan. So that's just a little preview of what we're covering here in these next few lessons. So let's start off talking about short-term loans with fixed interest. And I'm going to give you just an overview of what this tool looks like. And then I want Dykes to give his feedback as well. The basics of what I've seen with short-term fixed interest loans, you might have thought about these are ones that you might use for a fix and flip property. These are also ones that you might use for a property you're buying to rent, but you need to fix it up in the first place. And so maybe a 6-month loan, a third up to 36 months would be a pretty long short-term loan, but in some bigger projects, maybe that's the case. And often there's a range of what interest rates a private lender is willing to loan to you on these short-term loans. I've seen anywhere from 6 to 15% interest in these types of loans, and anywhere from 0 to 5 points or maybe more for an upfront cost of that loan. And Dykes, how would you define a point? I know I've always explained those, but what's the difference between interest rates and points?
A point is not time considered like interest is. Interest accrues over a period of time, whatever rate is set. A point is a multiplication at one point in time. So when the loan is made, if it's 3 points, 3% of the loan is points and is paid to the lender at the time of the closing. And later on, we'll talk about financing points into the deal. But typically, all banks take points up front at the closing. And 1 point is equal to 1% of the loan.
Great, thank you. So what I want to emphasize on this basic structure, this is a shorter time period. And as I mentioned earlier, it could be a flip deal. It could be a rental deal. Often, if you're owning as a rental, sometimes you're going to refinance this kind of property and maybe get a long-term loan later on. So that's a consideration. But again, the benefits of having a private money loan, you might be willing to pay a higher interest rate. You might be willing to pay those points because on a flip deal, you might have a $30,000, $40,000, $50,000 profit on the back end. And so you're willing to pay your lender a higher interest rate because of the availability, because they might be willing to move quickly, because they're more flexible, all those benefits we talked about in a prior lesson. And then, but these terms, these interest rates, the points, the amount of time that the lender will work with, and then we're going to cover a lot of other terms of the notes and mortgage. Those are going to be negotiable. Like you're going to have to speak with your private lender, talk to them about that. But this is the basic structure. You're going to negotiate those points. You're typically going to have a promissory note. That's the contract, the debt that describes the terms of the agreement you have with your private lender. That's one component. You're also going to have some kind of security instrument, some kind of security document. In some states, that's called a mortgage. Some states, that's a deed of trust. I know where I grew up and started investing in Georgia, that's a security deed, a little bit different animal there as well. But the point is, you're going to have two different documents there. You have your promissory note, and you're going to have a mortgage. And the mortgage, the way I always describe it, is this is the document, the contract that connects that debt that you have to the property. So you have to have both. If you didn't have a mortgage, you'd have an unsecured note. Like a credit card is a form of unsecured debt. So you're going to have both. Those are both documents that we'll cover in the course that you're going to want to have with this type of private lending note. And then the other things I wanted to add on there, though, is that you are going to want to have lender's title insurance for your private lender. And your private lender, even if they know what they're doing, they're going to ask for that. But even if they didn't know what they were doing, you'd want to insist that they have that. You buy a lender's title insurance policy for them. And then you also add them on your hazard insurance policy as well as a named mortgagee. So if you do have a fire on the property, for example, which I've had in the last 12 months on one of my properties, that mortgage, that lender would be also named, and they would be on any checks that insurance company pays to help them stay involved and make sure they're involved in the rebuilding or the paying off of the note or whatever the case might be. So that's just a summary. Dykes, do you have any other thoughts on that, on what this kind of basics of the short-term fixed interest tool looks like?
No, and I'm sure some people looking at this see that 6% saying, hey, I think I can get lower than that. Remind you, we're talking about short-term here. You've got to make sure that your lender gets paid for the effort they're putting forth and the fact they're loaning to you short-term. So don't cut them down too much, especially on the short-term interest.
Yeah, I've made a couple loans recently to a builder, and we've been charging 12% interest. And but sometimes my builder, if he goes really quickly, he pays me off in 3 months. And if I loan $150,000, that's $1,500 per month at 12% interest. And so about $4,500. And for me personally, like, I don't really want to get involved in a deal because there's time up front, there's effort, there's me evaluating the property, there's me doing draws. $4,500 is money, but it's not, you have to, as a lender, you got to understand your own value, your time as well.
Right.
And so as a borrower, if you want to keep that lender coming to you and loaning you more money, you want to take care of your lenders and make sure they consistently keep their money working. All right. So I'm going to give an example here just to kind of drive this point home. Let's say you are a borrower, an investor, you find a single family house and you're going to flip this house, and it has a $350,000 after repair value. So you might hear us use the term ARV to abbreviate that after repair value. And let's say your total cost, so your purchase plus your repairs and closing costs and things like that when you add it all up, it's $245,000. So you're buying this deal because you got a good deal on it. You got it below the full value. You bought it for $175,000 and your costs are about $70,000. That could be a typical deal that people who are flipping houses see. So how would the private money fit into that equation potentially? So let's say you went to a private lender and you found somebody who would loan you $225,000 for 12 months. That could be maybe a 6 months, maybe 6 months with an extension, but somewhere in the 6 to 12 month, I have found to be pretty common. And let's say that lender is willing to loan you money at 12% interest on that $225,000. So at 12% interest, that's $2,250 per month. And let's say they also charged you 2 points. So as Dykes explained earlier, that is an upfront cost in this case that this financed into the loan, or you might pay it separately, but $4,500 would be an additional cost to getting this loan. So this private lender is making that $2,250 per month. They're also making $4,500 in points. And importantly, and one of my most important criteria when I'm loaning money, but also when I'm borrowing money from somebody, is to look at what the loan to value is. In this case, that's a 64% loan to value. So that $225,000 is 64% of the full value of $350,000. And for private lenders, the loan to value is one of the most important considerations, because remember what we talked about earlier, the worst case scenario, if the borrower gets run over by a bus, you might end up as the owner of this property. Your private lender might own the property, and having their loan be a lower loan to value helps protect them in that case. They have more equity, more margin of safety, more cushion to help them in that scenario. So in this example we're talking about here, there's also a $50,000 draw for repairs. So, $175,000 is the purchase price. So when they go to closing, this borrower has to give the seller $175,000, but there's also an additional loan of $50,000. And what that private lender might do is say, hey, I'll loan you the $50,000 once that work is done. And we'll give you that money. You show me evidence that the work's done, or I'll come inspect it, and then we'll give you the rest of the loan at that point. But the interest is being charged on the entire amount because that private lender has to set that money aside and have it available for the lender. So it's more of a protection for the lender to hold that money back in a draw and then give them the money once that work has been done on the property.
Right, Chad, if you're the borrower and you have repairs that need to be done, especially if it's $50,000 worth, suggest that the lender, even though they might not say it themselves, put that money in escrow, hold that money out. So they get to come 1, 2, or 3 times, according to how many draws is set up in agreement, and see what you're doing on the property. That builds their trust in you and your credibility of being able to get projects done. And so you'll actually build a closer relationship with the lender by offering them to hold on to the money until you do the incremental repairs.
And go back to that relationship piece. They get to see your work. They get to be impressed. They get to see that you're actually staying on time. And if you follow through, which is always the big if, right? You've got to do your job and follow through. Then you're building that trust. And I have done deals different ways, and I'm not sure, Dykes, how you do it when you loan, but as a borrower, I've often, after 10 deals I've done with one lender, and if we keep repeatedly doing these flips, in many cases, they would actually let me set the money aside in my own money market account and take the draw up front. I'm not saying that's always going to be the case with every lender, but that's negotiable. If you as a borrower are able to get that, was my preference, is to go ahead and get all the money and just set it aside. And that just avoids having to do that. But it takes some trust for them to be able to go ahead and give you all the money up front. All right, so just some tips and cautions about this type of structure that we're talking about here, this basic structure. One is don't accept funds directly. So you want to treat your private lenders professionally. And I always told them, when I'm trying to explain the basics of how this works, if they're new to this, I would say, we're going to treat you exactly like we would treat a closing with a bank. So if a bank is loaning money and we go to a closing attorney and we get title insurance and we have regular insurance, if we do that with the bank, we're going to do that with you too. So the bank sends the money to the closing attorney instead of the person say, hey, Chad, here's $100,000 for the closing next week, and they hand it to you and you put it in your bank account. You want to have the formality of going to a closing, of having that paperwork, of having the money transferred through a closing agent, and treat them professionally. I think that's just a good practice that's going to have a lot of good implications for you down the road. The other thing is, and this is going to be a big part of this course, is you're going to prepare your own paperwork. I took this directly from some of Dykes' advice that I've learned from him over the years, is that if you go and ask a closing attorney, for example, a week before the closing, hey, can you prepare a note and a mortgage for me for this private loan that I'm doing? They will certainly do that for you. But what they're going to do is they're going to take some template that they have that's probably going to be very similar to what a bank mortgage would be, or a Fannie Mae, Freddie Mac type mortgage. It's going to have all of the clauses that are in those bank mortgages, which is part of the reason of you doing a private money loan, is to customize what kind of terms and paperwork you have. So the other tip here is, and part of your upfront work and why you're taking this course, is to learn some of the clauses, some of the important paperwork that you want to use, and create your own paperwork. And you can still have your local attorney, and you should have them look it over with you. But you don't want to just blindly go in and say, hey, prepare a note and mortgage for me, because you'll get all sorts of things from that in that case. Dykes, do you have any other comments on that, or on either one of those, the funds or the paperwork from these type of deals?
I got a little something to say on both. The funds should always go to the closing attorney and should be put in his escrow account until the closing occurs. Someone may trust you emphatically, and they give you the $100,000, let you put it in your bank account because they think it's going to close the next day or two. Next day or two comes and some title work hadn't gotten done, or the attorney's behind in closings, and it gets pushed off. And long and short of it, it might get pushed off 2 weeks. And now your lender is really afraid that that money is in your account rather than the attorney's account, and they're wondering what you're doing with it. don't put them in that situation because they want to be nice to you. They don't want to challenge you or confront you. Do it like a good business person, professional would do from the beginning. That is, get the money in the attorney's account and explain to the lender that you want to make sure that if you walk in front of a bus, that they got all the paperwork that they need, or they got the money, one of the two. Now, preparing your own paperwork, that is something I feel like is very important for real estate investors. Remember, attorneys are nothing but technicians. They're going to do what you ask them to do. If you ask them to do a owner carryback financing or ask them to do a private loan documents, they're going to do documents that are as simple as they can produce, simply because they don't want you coming back to them and say, well, why'd you put this clause in? Or why'd you do this? If you're a knowledgeable investor, they'll put more clauses in, but they still wait for you to ask them to put them in. If you've got to ask, why in the world are you paying the attorney for doing all that work? Do it yourself, and then just tell the attorney to confirm that the documents are legal under current law and current court cases before, as a part of doing the closing.
And I will say, it's not been easy. It's like any profession to find. There are attorneys out there who understand some of these creative terms and use them, and they're typically the commercial attorneys who are working with bigger, land investors and commercial investors. But not. I guess my point is, not every closing attorney. They are an expert in a certain type of thing, not necessarily this deal that you're doing. This a little bit different than what they see every day. So I would just give that feedback. The last 2 points here, just tips and cautions, are when you're looking for lenders for this type of deal, one of the benefits is that they can move quickly. So you just want to make sure they understand, hey, like if they're committing to give you the money, hey, I'm going to get a deal under contract, and it's possible I might need to close in 2 or 3 weeks. Maybe, I've had the fastest one I ever did was a Monday to a Friday. Got under contract Monday, closed on Friday. And so you just want to have that conversation with them and tell them that's one of the reasons I'm coming to you, is that money needs to be available. And if they are having to move it from one account to another or whatever, it needs to be in a place where they can ideally write a check. But even if they're having to go to an institution or account, they have that ready. They can move it quickly, and they understand how quickly that money can get from one place to another. And then the final comment, this is about relationships and long-term, just good business with each other, is to communicate with a lender, especially when you have problems or delays. Don't run from those problems. I've had problems a couple of times with lenders in terms of, we made a mistake and the payment didn't get to them. We did bill pay from our bank and it just didn't get to them. You want to be the one who's ahead of those problems, and you apologize. It won't happen again. Let me fix this. Or if there really was a major problem with the market, for example, you don't want to put your head in the sand. And I found that attitude of being willing to confront those issues when they happen and get ahead of them is part of you building credibility with your private lenders. And if you start from the beginning doing that and paying attention to that, I think you'll find a lot more success and a lot more trust with that private lender, because that's a rare quality. Not everybody does that. Not everybody's willing to own up to that. And so if you'll take that approach, I think that'll benefit you a lot.
Chad's exactly right. Let lenders know if there's a problem coming up, whether you expect them to find out otherwise or not. Let you be the one to tell them. But don't ever go tell them a problem that you're dealing with without telling them what you think the solution is going to be and what you're doing to solve the problem. Don't drop it in their lap. Just make sure they understand that you're doing everything you can to solve the problem. And then, of course, as soon as you get the problem solved, let them know that the problem is solved.
So that concludes what we're going to talk about with a short-term fixed interest loan. We're going to now go into a few other variations of this that might be useful for you to use in other situations when you're borrowing money over a short period of time. If you have any questions or comments from this video, I would love to hear from you in the comment section below. And like I said earlier, this is a clip from a larger course called Creative Financing for Real Estate Investors. So if you want to learn even more about private money, seller financing, lease options, buying subject to the mortgage, and to get all the details and the paperwork on how to actually use these tools as a real estate investor, you can see a link to our course in the video description below. And if you like this video, be sure to hit the like button to help us spread the word on YouTube. And if you're new to the channel, be sure to hit the subscribe button and the little bell so you don't miss anything. I have new videos that come out every Friday morning, tutorial videos just like this, and every Monday I have a full podcast episode as well. And if you like this video topic of creative financing, I think you'll like my creative financing video playlist here on YouTube, where I go into all the different tools that you can use as a real estate investor to finance your deals without stepping in the bank. You'll find that above me here somewhere, or a link in the video description below. You've been watching Coach Carson TV. My name is Chad Carson. You can also call me Coach. And this is a channel all about investing in real estate, achieving financial independence, and doing more of what matters. See you next time.